and Chief People Officer, Mr. Ramachandran Sundararajan. I would now like to hand it over to Mr. C. Vijay Kumar. CVK, over to you.
Thank you. Good evening, everyone. Thank you for joining us today for HCL Tech's FY25 second quarter earnings announcement. Sorry for the delayed start. I am really delighted to welcome Shiv Walia, our newly appointed Chief Financial Officer, to this quarterly call. Shiv has been with us for more than 3 decades and has been an integral part of our success over the last many years. We're also joined today by Kalyan Kumar, who's a Chief Product Officer for the HCL software business. Kalyan Kumar KK, he will provide some insights into our HCL software's performance for the quarter. Additionally, we have Ram, our Chief People Officer, whom you're all very familiar with. From an overall quarter perspective, it's been a strong quarter. We've delivered across the board as we see the business momentum starting to pick up. I am happy to share that in terms of revenue, we delivered a sequential growth of 1.6% and a year on year growth of 6.2% in constant currency. Our operating margins came in at 18.6%, an increase of 149 basis points when compared to the last quarter. Our HCL software business grew 9.4% sequentially and 6.4% in H1 FY25. The sequential growth is on a year on year basis. The software growth is really demonstrating the increasing relevance of our products in the digital economy. Our software business is moving in the right direction with an impressive annual recurring revenue of $1.05 billion dollars. And this performance is a testament to the team's hard work and dedication, and it reinforces our position as a key player in the industry. And to top it all, HCL was ranked as the number one company in Time Magazine's World's Best Companies 2024. Our services business grew 1.6% sequentially and 5.9% year on year in constant currency. And this is despite the headwind we had due to the divestment of the State Street JV business. Our IT and business services grew 1.8% sequentially and grew 6.2% year on year, while our engineering and R&D business grew 1.1% sequentially and 4.3% on a year on year basis. In terms of booking, we won 12 deals from services and 8 deals from software, bringing the total to 20 deals in Q2. Our total booking TCV for Q2 stands at $2.229 billion. Now, coming to the geographies, all the three geographies grew sequentially this quarter. Our rest of the world business clocked in a strong sequential growth of 7.2% in constant currency, which was largely driven by our financial services and manufacturing businesses. From a year on year constant currency perspective, Americas grew 7.5%, Europe grew 4.2%, while ROW declined 2.6%. On a sequential basis, our top three performing verticals were retail CPG, life sciences and healthcare, technology and services. And on a year on year basis, the top performers were telecom, manufacturing, and retail CPG. We continue to grow our client category in a very impressive way because of the focus that we have in cross selling of our services. On a quarter on quarter basis, we added 4 clients in the $50 million category and 4 clients in the $20 million category. In terms of Gen AI, I'm very pleased to share that this quarter has been marked by significant achievements in our Gen AI related programs. We've seen strong wins with most of our deals incorporating AI capabilities. Our Gen AI platform, AI Force, is gaining widespread adoption for service transformation among our clients. We continue to witness excellent traction in AI and Gen AI opportunities, driven by our offerings such as HCL Tech AI Force, HCL Tech AI Foundry, and the AI Labs. Notably, AI Force is now integrated with Microsoft GitHub Copilot and will soon be enabled as a Copilot extension, providing unmatched extensibility into strategic collaboration with uh, AWS and Google Cloud to accelerate Gen AI adoption. HCL Tech AI Force is now integrated with Anthropic Claude 3 in Amazon Bedrock. These developments position us strongly in the AI landscape and demonstrate our commitment to innovation as well as service excellence. Looking ahead, our pipeline continues to grow robustly, demonstrating a strong and well distributed presence across business segments, verticals, and geographies. Gen AI presents a particularly exciting opportunity, growing at a commendable pace. Our clients have already begun to reap the benefits and value from their AI and Gen AI projects. This trend underscores the significant role technology plays in driving change and in enhancing business outcomes. Overall, this reiterates the fact that clients continue to value technology and its impact on our businesses. We, however, remain cognizant of the geopolitical factors and global economic conditions which can impact growth. Looking ahead, I'm thrilled to share that uh, we remain very positive about the opportunity. We've been recognized as India's number one company in Time Magazine's World's Best Companies 2024. This remarkable achievement inspires us to be even more optimistic about our share in the technology spend for our clients. We're committed to contributing significantly to the goals of our employees, clients, and shareholders. With that, I will hand over the commentary to Shiv Walia to provide more depth to our financials. Over to you, Shiv.
Thank you, CVK. Good evening to all of you in our financial earnings call. Let me walk you through our financial performance for the quarter. Start revenue performance. Total quarter is rupees 28,862 crores, which is a growth of 2.9% quarter on quarter and 8.2% year on year basis. To the services side, services revenue came in rupees 26,089 crores, with a growth of 0.9% quarter on quarter and 7.8% on year basis. Software revenue for the quarter came in at rupees 2,085, growth of 2.7% on quarter and 1% on year basis. Happy to share that this represents our highest ever year-on-year growth for software business. Moving on to the profitability matrices, at 362 crores at 18.6% of revenue, 149 basis point quarter, up BPS on a year-on-year basis. 1% quarter on quarter, 8.7% on a year-on-year basis. Income for the quarter is rupees 4,235 crores at 4 revenue. I would also like to spend a minute on our return on invested capital, OIC. Our ROIC is our ongoing focus on profitability and management. The last 12 months ROIC is at 35.7% for the company, BPS year on year, and services ROIC now is at 43.5%, up 400% BPS. And thanks to our good performance, software ROIC at 17.8%, up. Cash generation is another highlight I would like to focus your attention on. Our cash generation remains very strong. 909 crores While cash generation was rupees 19,800, and our balance sheet remains strong with gross cash at rupees 28,800 crores and net cash at rupees 26,521 crores. Operating cash flow to net income conversion is healthy at 126%, and flow to net income conversion is at 100. This cash generation has improved on back of our improved DSO performance. Total DSO including unbilled is currently at 79 days, a 3 days improvement quarter on quarter on a year basis. Shareholders, the diluted earning per share for last 12 months came in at rupees 62 rupees 0.02 paisa, which is up 8.9% year on year. The board has declared an interim dividend of rupees 12 per share for the quarter. The board date is 22nd of October 24 and the payment date of the same week 30th October 2024. That brings our look at rupees 50 share, effectively distributing 86.9% of our net income. That's all from my side, and now I am handing it over to Kalyan Kumar for an update on software business. Over to you, KK. Thank you.
Thank you, Chef. Good afternoon. Thank you, CVK, for the opportunity to share the HCL software commentary. We started to witness early results in the transformation for HCL software, which is built around the 5 key focus areas, which I will talk about in a moment. Zooming on the JAS 24 quarter, our H1 revenue for software came in at about 676.4 million, which represents a 6.4% year-on-year constant currency growth. And ARR in September 2024 stood at 1048.9 million. I would like to call out some unique deals which we signed across the planet, which contributed to this JAS numbers. So starting with our business application software portfolio, which really enables CX journey for our customers around commerce, MarTech, and aftermarket. A large Japanese agri-tech provider has signed up for HCL Aftermarket Cloud to enable aftermarket across their entire landscape. And a large Belgian telecom provider is deploying HCL Unica MarTech platform along with the native HCL CDP capabilities to orchestrate their customer journeys. In our total experience portfolio, where our platform orchestrates multi-experience across DX, MX, EX, and CX, a leading digital-first Caribbean government has selected us to deliver a full suite of government to citizen services on our DXP low-code, no-code platform. We have a large US state government who signed up to deploying TX platform and expanding the citizen usage. And a large European defense forces is currently deploying DX along with Volt MX to enable their digital soldier service experience. So a lot of this is enabling total experience as a holistic portfolio. In the intelligent operations and cybersecurity product line, where our software drives a lot of shift towards AI-led human-assisted operations, a major retailer in South Africa started to deploy HCL BigFix Autonomous Endpoint Management, which provides end-to-end operations and management of the infrastructure, automation, and orchestration estate. A large private bank in India is adopting HCL Workload Automation or the Automation Orchestrator Suite to deploy legacy workload automation across their entire mainframe product line. Third is we also have a very large oil and gas PSU in India, which is deploying HCL BigFix AEM, again, to manage their entire estate. In the Acti and data analytics portfolio, where we enable confidence-driven data analytics and intelligence and governance, a large UK-based SaaS ISV is deploying Acti and Zen to enable their entire SaaS ISV program. Also, with the newly acquired Xenia Data Discovery and Data Catalog platform, we've added about 40 net new customers, for which addresses chief data officers and other stakeholders, which will enable us in the data prep for Gen AI for a new vector of growth. So now let me give you a quick view on what are the 5 key areas which is really driving the momentum for our revenue. The first is around customer success and renewals. Our primary focus continues to ensure sustained innovation of our existing products so that we can drive better value creation for our customers. The second is around sharper growth product areas. So we identified areas like network commerce, platform-based commerce, data and AI-centric MarTech, total experience platform, intelligent operation software to really enable some of these core capabilities. Third, we've significantly focused on emerging markets. We've defined Americas, APJ, and Europe as mature markets, and we're focusing on Middle East, Africa, and India, South Asia as the emerging market focus. The fourth is we've significantly invested on a new software motion, which is about selling new products and capabilities. And we've added focus teams in these geographies with product sales specialists, technical advisors, marketing and business partner teams. And finally, extremely important is our 360-degree ecosystem. We're enabling our partners across hyperscaler, GSIs, and business partners into the market. I would like to thank 7,200 plus HL software employees and the teams and our extended partner ecosystem to help us continue, nurture, and drive better delight for our customers. In closing, our purpose of bringing technology and people to build products to provide sustained value for our customers, partner, and communities will continue to drive success for HCL software. Thank you, and I'll hand it over to Ram.
His connection is frozen as well.
Sorry, everyone, for some technical error. We'll be joining in again just a minute. Ah, I guess we are facing some technical issues. We'll now open the floor for the question and answers. Before we begin the Q&A, I would like to share some key instructions with you all. In case you drop out, please rejoin us using the same invite link. If you experience any technical difficulties, you can message us using the chat and Q&A panel. When you want to ask a question, please press on the raise hand icon. We will call out your name and unmute your line. Our first question today is from Anisha Jain from ET Now. Anisha, please unmute your line and go ahead.
Hi, gentlemen. Good evening. Thank you so much for this opportunity. Anisha Jain from ET Now. I'm just going to bunch up all my questions together so that you guys can answer it. CVK, to begin with, the revenue profile is very strong this time. Was there any bunching up of billings, etc., that happened? And also, if you can give more color on the incremental demand environment, is it much better than what you saw in the last quarter? Shiv, from you, first up, thanks so much for speaking to us. First time that we're speaking, so hi from my side. If you can just help us with a walkthrough of the margins as to what really aided it, and in Q3, what kind of impact should we envisage of the wage hike? Ram, if your connection is better now, a word as to the net headcount decline that we saw in the quarter. Are you back at the campus? Because there is a bit of a fresher addition as well. So if you can throw some light on that. And KK, just a question for you on the software margins. If I have it right, the margins came in at 25.6% versus less than 21% last quarter. So what led to that 500 basis point improvement there? Is it better pricing or something like that which has come through? So yeah, these were the questions, guys.
Okay, Anisha, thank you for the long list of questions. We will answer one by one. Obviously, there is nothing like bunching of revenue or anything like that. It's like a normal quarter where incrementally the demand was better. So services overall revenue came much higher than what we expected. So that's really good fulfillment of the demand that was coming our way across all the verticals. We did share in the last quarter that we shared last quarter that all the verticals will grow sequentially except financial services, which was going to decline because of the State Street JV divestment. But even if you kind of exclude that, financial services has grown the strongest. So I think the demand, we did call out that we were already seeing some green shoots and some pickup in demand in financial services, which really played out extremely well. Demand was strong in FS all through the quarter, so it was really a fulfillment game. I think the similar situation we saw in technology and services and a few other verticals. And some of it is also because of the deals that we signed in the past, they got into execution. In addition to the pickup in demand in services, software business, where a lot of things happen in the last month and even the last week of the quarter, uh, definitely delivered a stupendous performance, which overall helped the revenue growth to be better than what we expected. And software performance also helps on the margin side, which was your last question, but that's probably all the revenue that comes above a certain level flows directly into the bottom line, and that's the uh, logic there. Shiv, over to you for the next question.
Civic, I missed that question. Could you please repeat the question?
Shiv, hi,
Anisha, could you
Anisha here.
repeat?
My question was, my question was on the margin walkthrough. If you can break it down for us as to what really contributed to the margin improvement, and in Q3, wherein we are expecting a wage hike impact to come in, what would be a reasonable assumption of the margins in Q3?
So in terms of margin walk for this quarter, it it improved by 149 bps. So out of that, 52 bps improvement was contributed by software business. Services business improved by 110 basis point, which was largely driven by operating efficiencies, and 24 bps contribution came in from the favorable exchange movement. In terms of Q3, I think we are confident of delivering a good quarter, but difficult to call out. I would not like to call out the margins for the Q3 because we have given the full year guidance now, which is 18 to 19%, and we would like to stick to that.
Okay, Shiv, directionally at least, is it going to be similar to that 18.5, 18.6, or there could be a dip because of the wage hike impact?
No, as I said, we would like to stick to the annual guidance only, which is 18 to 19%, and we are confident of achieving those guidelines.
Sure.
I'll move
I think
forward.
Ram, can
CVK,
you
you can
answer?
answer my question on
Yeah,
incremental demand clearly. If you can add a bit more color around that.
Yeah, I mean, incremental demand definitely got better during the quarter across multiple verticals. While initially we talked about financial services was strong, but financial services was strong all across, not just in North America, Europe, and Asia Pac. A lot of growth in rest of the world was contributed by financial services. Then technology and services, life sciences, retail CPG, all of that had a good mix of efficiency-led programs and ongoing demand. A lot of it is data and AI related and SAP related. That's was uh, the nature of demand. And Ram, could you answer the rest of the questions?
yeah, sure. I think there was a question on the headcount. Yes, there's a slight drop in headcount this quarter, but if you look at the headcount on a year-on-year basis, after normalizing for the divestiture that we reported last quarter, our headcount is still growing. Overall headcount has grown if you look at it on a normalized basis. I think you also had a specific question about the freshers. I think we are continuing with our fresher program. The campus programs are on. As I keep saying, our plans are generally made for a full year with a review each quarter. So we do make our moderations each quarter based on the demand movements. Into FY26, the cycle that we are recruiting now, I think the focus is more going to be on specialization that we will focus on in campuses, not just go by pure numbers. That's what is going to be the focus, and those plans are getting finalized. It will be done during this quarter, but the campus program is on. Year to date, if you look at our fresher additions, we've added 4,000 plus freshers year to date in this fiscal, and we'll continue the program.
And
Thank you,
thank you,
Ram.
CVK, for answering the question. So I don't need to answer.
Yeah.
Thank you, Ram. Thank you, KK. Our next question is from Rima Tendulkar from CNBC TV 18. Rima, please go ahead.
Hi, gentlemen, and congratulations on a very strong quarter. CVK, you said revenue was better than your expectations. If you could tell us how much better was it compared to what you were earlier anticipating? And also, what was the BFSI growth X of the State Street JV impact?
So I think probably roughly 20, 22 million more than what we expected, right? From the beginning of the quarter till end of the quarter. Usually there isn't that much of a variation, but in a good demand situation, this has happened. Uh, so the second question was BFSI. Roughly 30 million was the impact of the State Street JV. So whatever growth we have provided plus 30 million. So it will be like roughly 4% plus sequentially.
BFSI growth is 4% plus. Do you feel confident now, given the momentum that we are seeing, CVK, that maybe growth will be closer to the top end of the market, top end of your guidance, revenue guidance? And how are Q3 furloughs? In line with what we've seen, or because demand is picking up after a long lull, this time the furloughs could be less, like what we had in the aftermath of COVID, where in Q3 we didn't see those typical furloughs.
No, I think right now our assumption and what we are hearing from the customers is the furloughs will be similar to the last year. So that's what we have assumed, and that's what we are seeing so far in the quarter. Now, from a guidance perspective, of course, we've done well in the first half, even better than what our internal assumptions were. So that really helps us to increase the guidance on the lower end from 3 to 3.5%. Now, higher end will depend on various factors. We have almost half the year to go, and it depends on the booking, it depends on the sustained demand environment. We are a little bit cautious to call out anything more than that because if you look at 2022, November, December is where we got some weakness signals. So we are just cautious because still there is macro situation, geopolitical, all of that we're cognizant of. So we remain cautious about extrapolating too much out of the two-quarter performance.
Thank you, CVK. Our next question for today is from Jas Bardia from Mint. Jas, please go ahead.
Hi, good evening. Just a bunch of questions. If you can just help me understand why you have increased the lower end of the guidance from 3 to 3.5%. I could not get much clarity on the demand environment overall. Second is on the HCL products business. So while we see a 510 basis point rise, it's still not the 30% margin that you had envisaged after the IBM deal was signed. So first, what gave the shot in the arm to the software products business? And second, do we see this sustaining? That would be it. Thank you.
No, I think we increased the guidance from the lower end from 3 to 3.5% based on simple math. First half, we have done better than our expectations. So that gave us the confidence that the lower end of guidance can be 3.5%. At 3.5%, we need to grow maybe 0% for Q3 and Q4. And at 5%, we have to grow at 2% in Q3 and Q4. So that's the math. On the demand environment, I did talk about it. I mean, we see demand, good demand in financial services. That's also extending to other verticals. But we are a little cautious about extrapolating this for a longer period of time. We are going to take it one quarter at a time because in 2022, in November and December is when we got the signaling about the weakness on the demand environment. Software products, yeah, I mean, this is, see, software products quarterly EBIT is not really, I mean, it can fluctuate based on the revenue growth. I think overall, we are generally comfortable in the 23 to 25% range. And that's what we are delivering now. And sustainable, obviously, I mean, KK talked about a number of levers. So each one of them are well thought out and we are executing. So we believe in the mid to long term, of course, the levers are sustainable, but quarter to quarter, there can always be variations.
Thank you, CVK. Our next question today is from Beena Parmar from Economic Times. Beena, please go ahead.
Hi. Firstly, we want to know what are the key triggers for the sequential drop in net profit? Could you just highlight that? And any mega deals during the quarter which you could kind of specify, and what's the pipeline for the same? And overall, the commentary on the Gen AI was quite upbeat. Could you give some specifics around, what kind of Gen AI deals did you see? Any numbers and any impact on revenue expectation or in the current quarter?
Sure. We'll answer one by one. Shiv, why don't you answer the net profit question? Then we'll.
So net profit in dollar term, it was flat quarter on quarter, bit of a drop in INR terms. One of the main reasons was that CTA adjustment, which was booked linked to State Street divestment, which had exchange gain booked in AMJ P&L, and also we had one of the net income got booked because of divestment we did last quarter. That was the main reason for a flattish net profit quarter on quarter in dollar terms and slight lower net profit compared to last quarter in INR P&L. Yes, CVK.
Yeah, there wasn't a mega deal last quarter. So we had a good mix of large deals and small deals. We've called out all the large deal wins in the investor release. We signed an end-to-end ITO deal, including ADM with a Fortune 200 manufacturing and electronic distribution company. This was really the differentiation was our AI Force platform, which helped us migrate this client from a long-term incumbent. And if you look at Gen AI, of course, there are three dimensions to this where we are seeing good traction. The first is AI Force, which is driving the service transformation. It's a service transformation of all the footprint that we have with our existing clients. We have almost 25 clients who adopted, who started working on AI Force as a platform, as the primary efficiency platform for all their IT and business processes. And then we have HCL Tech Enterprise Foundry. This is really helping in all the data-led innovation. So there are numerous examples where either POCs or in some cases it's close to being in some reasonable scale of production. And the third is, of course, continuous experimentation from through our AI labs, where clients can come in with an idea and walk away with a minimum viable product. So all these three dimensions, very, very sharply defined solutions. And we've talked to analysts, we've talked to our customers. All of them feel very excited about the pragmatic approach that we are taking in bringing very meaningful, tangible results through platforms like AI Force and HCL Tech AI Enterprise Foundry.
Thank you, CVK. Our next question is from Srimani from Times of India. Srimani, please go ahead.
Hi, am I audible?
Yeah.
Yes, Srimani, you are. Please go
Yeah.
ahead.
Yeah, a couple of questions. On the HR front, first of all, what is the situation on the hikes? And when will you be rolling it? And the hikes, the impact itself, what extent would it be? Would it cause an impact on your financials in the coming quarters whenever you roll it out? And to what extent also would it be? And Ram, just wanted to get a sense. I think if I was just looking at the sheet, even YOY, your headcount seems to have dropped only. But if you could just help us get a sense. Somebody else also asked that question on why exactly there has been a decline, just a marginal decline, of course. But you did mention it last quarter it was because of straight seat. But if there are any other factors that led to this overall decline. And CVK, I'm just trying to still get an understanding of, what are the two or three major points that have contributed to the revenue, the revenue increase this quarter. If you could just help us with that.
Sure. Ram, why don't you answer?
Yeah, I'll first take the headcount question first before I come to the wage increase question. Year on year, I think it's important to look at it in a normalized scale. If you look at just quarter of 23, that still had the State Street headcount roughly about just shy of 8,000. So if you normalize for that and then look at a YOY comparison, it'll be 2.2, 2.3% headcount growth is what you would see. So that's what I was referring to in terms of year-on-year comparison. The slight drop is largely on the back of some of the efficiency levers that we are driving in our business. It's also a shift in pyramid that we see, with more requirements for data skills and commercial app skills and other things. You would find the pyramid shift. That's also contributing to the change that we see. That's broadly the reason that we observe in terms of where the headcount is moving. So increasingly, it's going to be more focused on specialization and skills and experiences that will mean more for us. To your question on salary increases, so we have decided to go ahead with the increase. It will be along the similar lines as what we did last year, which means the increases will be effective October, i.e., this month. The quantum of increases, typically every year when you look at the review cycle, given the fact that we have a higher proportion of people who come in laterally into our system, who will become eligible for increases at the point of completing a year. The number of individuals eligible for increases during a given cycle is a function of that plus the performance. So the average, if I look at for all our colleagues in India, will be in the range of about 7%. But as is always the case, increases are linked to performance, and top performers will continue to see double-digit increases in the range of 12 to 15%. So that's the way we have planned our increases. As I said, it'll all take effect from this month onwards. We have our own comp review cycles, which we follow every year. That's what we did last year. That's what we'll do this year as well. I think you also had a question about what will be the impact of these wage hikes on our margins. It's usually the case that when we go through a comp review cycle, there'll be a small impact in terms of the increases itself on the wage bill. Obviously, our efforts will be to offset that with the efficiency levers that we continue to drive.
Yeah, and on the major points driving the growth, I think I've said this earlier in the call. Services business delivered more than what we had expected, and that's contributed by both our digital business and digital foundation services. And engineering services grew at about 1.1%. IT and business services grew 1.8%. And if you exclude the divestment impact, the growth would be much higher, almost close to 2.8 or 2.9%. Multiple accounts in different verticals, like financial services across all the different segments, insurance, banking, capital markets, and fintech. We found good growth through the quarter. And in life sciences and healthcare as well, in payer and provider, we saw some good improvement in demand. And in retail, CPG, and other verticals, it was the execution of some of the deals that we won in the previous quarter, which contributed to the growth. And software
Thank
was
you.
a bigger contributor as well, because it grew about 9.6% year on year in a seasonally weak quarter. So that also handsomely contributed to the growth.
Thank you, CVK. Our next question is from Devangana Ghosh from Money Control. Devangana, please go ahead. Devangana, you can unmute your line and please go ahead.
Hi, am I audible?
Yes, you are. Please go ahead, Devangana.
Yeah. Hi. I had a couple of questions. Firstly, wanted to understand how are the Gen AI deal sizes shifting at the moment? Because your peers, Accenture and TCS, has pointed out that previously the deal sizes was in your sub $1 million range, but that now looks like it has started to grow to a $10 million deal, $30 million deal. So wanted to understand how that is shaping up for HCL Tech. Secondly, Fed rate cuts, how is that impacting your clients' discretionary spending plan? Has that started reflecting on it? And also, thirdly, wanted to understand the 18.6% operating margin. Is that range going to be sustainable on a quarterly basis in the upcoming quarters as well?
Okay, let me answer your questions. First couple of questions, and maybe Shiv can answer the third one. Gen AI deal sizes, while it is very interesting to talk about the deal sizes in Gen AI, which usually are very small, but in my opinion, that is not relevant at all, because Gen AI as a technology is enabling a lot of new things to be done. So all the spend which makes these new things happen, that is where the bigger deals are going to come. For example, because of Gen AI, legacy modernization is going to continue to become a very, very big demand. So while GenAI is the technology that is used, but the work that we will do is all legacy modernization and retiring technical debt. So that's one big outcome, even though the GenAI component will be small. The second aspect is when you want to drive any innovation through GenAI, data becomes a very, very important ingredient. So there's a lot of spend around data in streamlining data, establishing data pipelines, metadata management, all of that becomes critical. And the third element is a lot of POCs are unable to scale to large execution models because of the infrastructure limitations. So, cognitive infrastructure, whether it is on hyperscalers or on premise, that's the third area of spend. So, because of Gen AI, these three big demand drivers are very visible. So, whatever deal sizes in Gen AI itself, in my mind, is not relevant. It is how is it enabling the other modernization and all of that the clients want to do. That's what is most important. Fed rate cut impact, it's very difficult to call out. I'm not really sure what part of the demand is due to the rate cut and what is not. But maybe the customers have been a little bit reluctant to spend for some time. They feel uh, because of Gen AI and other possibilities, they feel a little more confident about modernization journeys. Beyond that, I'm not able to see a direct correlation. 18.6% sustainability, Shiv, why don't you answer?
Yeah, sure, CVK. So the way it works for us, the Q1 for us is the weakest quarter because of the productivity pass-through, which happens in that quarter. Then it picks up in this quarter, Q2. And for us, the Q3 is the strongest quarter in terms of profitability because of seasonality in the software business. And then it comes down because of JFM, the seasonality of the software is not there. So it's difficult to pick out, that's how our margins behave on a quarter-on-quarter basis. So it's difficult to call out any specific trend or maintaining the same consistent margins. As I said, Q3 for us is the strongest quarter because of seasonality of the software.
Thank you,
But
Shiv.
but I
Our
think
next,
that we have given a full year guidance, and we are confident of achieving that guidance of 18 to 19%.
thank you, Shiv. Our next question is from Shivani Shinde from Business Standard. Shivani, please go ahead.
Hi, gentlemen. Good evening. Congratulations on a great set of numbers. My question is most directed to Ram. Ram, you said you're focusing on specialization when you hire it, right? And I'm assuming this is also for freshers. So if you can elaborate more when you say you're looking at specialized talent, what does it mean from a strategy point? And two, does it also mean that the entry level salary for these freshers will be more than what you give to a normal student that you hire? One is that for you, Ram. To KK, when you talk about the software business, do you feel that the emerging markets is a faster growing market for this category, or is it overall spread across geographies?
Okay. I'll take the question first, KK. Maybe you can come in later. I think two parts to your question. One, what do we mean by specialization, and will the compensation vary, particularly from a fresher's point of view? So, firstly, when we talk about specialization, it does apply to freshers as well. If I look back in the last 12 months, last 4 quarters, the freshers that we have onboarded, we have people coming in from different backgrounds. Even in terms of engineering, people come with different backgrounds. Today, we increasingly find students specializing in data, specializing in AI. So some of these disciplines do attract significant skills for them to be able to get to project mode very quickly. So that does attract different levels of compensation. So the normal headline compensation that everybody refers to as 4.25 lakhs, it's what I would refer to as very generic background for students. But if you look at folks who come with specialization, they do get higher levels of compensation. So, for example, if we take freshers who come into our products business, the compensation could be almost 4 times the standard headline compensation that will be there. Folks who come in with specialization who get into our data practice will be as high as 2.5, 3 times the base level of fresher compensation. So there is difference based on specialization that students come with. So that's the reason I called out saying that when it comes to freshers, increasingly it's going to be on what specialization we focus on, not necessarily just total numbers. So that's insofar as the specialization and compensation associated with specialization in what we onboard. I don't know what you had a second question as well. I don't know if I missed that or I've answered.
That was for KK. That was for KK.
Okay.
KK, you're not audible. You're breaking.
So, okay. So,
Yeah, now
am I
is
audible now?
go ahead. Yeah.
Yeah.
And patterns and
KK, you are not audible. So maybe, let me respond to you, Shivani. I think your question was, is the uh, India and emerging markets a bigger market or higher growth market for software? We think yes. These markets offer a lot of opportunities, and you can also see that in the deal wins that we have announced. A number of deals are in some of these geographies. And the US as well is a good market. US and some of the emerging markets are big focus area. Okay, thank you.
Thank you, CVK. Our last question for today is from Sai Ishwar. He has dropped his questions in the chat box. These questions are for you, CVK. Number one, is discretionary spends better than Q1? Number two, will we see more MNCs carving out GCC operations similar to State Street and reducing their dependence on IT companies?
Yeah, definitely discretionary spend was better than Q1. And yeah, I think the capability centers and IT service providers will coexist and feed into one another. There is certain type of work which is best done in an outsourced model, and a certain type of work customers might want to do it in-house. So I think while of course there is a little bit of deflation in the total addressable market for service providers, but that is insignificant because if you look at the total addressable market for large GSIs is in $1 trillion plus. So from that perspective, some market share going into GCCs, uh, it doesn't really impact the big picture growth opportunities for service providers. And we work very, very closely with a lot of capability centers. We help them to scale, we help them to innovate. So we are very much integral to the ecosystem that is servicing the global capability centers. Thank you.
Thank you, CVK. Thank you, CVK. That was the last question for today. And with this, we will now be closing the press conference. Thank you, everyone, for your valuable time and presence. Please note, the recording of this webcast will be available on the HCL Tech website. Stay safe and take care.